Well, after getting the hot hand during the SVB crisis and the fallout from there, the past two trading sessions have been marked by weakness in the tech sector. Tom Essaye is the founder and president of Sevens Report Research and joins us now. Tom, it is interesting that as we start to see a little bit of stabilization in the financial sector, you're also seeing some of that wind come out of the tech sector. What do you make of that?
Good morning. Thank you very much for having me on. I think it makes sense, right? Because it's always important to understand why certain sectors are rallying. And in the case of tech, it rallied almost on a flight to safety, right? As the banks were under stress, where was money running to? It was running to the mega cap tech stocks, right? Your Apples, your Microsofts, your Googles. And it was almost going there for safety because they don't need a bank, those companies, and they're somewhat insulated from a lot of the regional banking stress. Now that people feel a bit better about the banking crisis, we're seeing that scared money come back out and start to tiptoe into the rest of the market. I imagine that'll continue if the headlines on banks stay somewhat calm.
It's fascinating that this seemed like a crisis. It was a crisis in terms of we haven't seen a failure of a bank since the financial crisis, yet since that time, the S&P 500 is actually up. And so we didn't get a pullback. We didn't get a correction in any major way. Certainly in sectors we did, but not in the overall index. What do you make of that?
I think part of it has to do with how heavily weighted tech is in the S&P 500, especially for here in the United States. If you look at 2022, the S&P 500, the SPY, that's the market cap weighted version of those 500 stocks, badly underperformed an equal weighted version of those 500 stocks. It's flipped now, and it really goes back to how heavily weighted tech is in the major industries here in the United States. But the banking crisis is so far a moment in time, right? That doesn't derail the bigger issues we have to deal with, not just in the United States, but in Canada and globally, which is still higher inflation and decades high interest rates. So it's really just complicated what was already a quite complex market.
And so many had tried to kind of lay the blame on this situation. You know, the Fed has raised rates, very extraordinary pace, and now they broke something. We're also getting the Senate banking testimony today where Michael Barr right now is speaking, the vice chair of supervision at the Fed, and really trying to place the blame just with SVB, saying this is a textbook case of mismanagement. So going to great pains to say this is not systemic and really just lies with these few individual banks. Would you agree with that assessment?
No, and here's why. What he also revealed, because I was watching the testimony right before I came on with you, was that the Fed was aware how mismanaged this bank was, right? They knew that they had tremendous duration risk in their interest rates. They characterized it as mismanaged and as a weak bank. Yet it failed anyway. They did nothing to shore it up, and then now taxpayer dollars have to go in to make sure that we don't have more contagion. So I think the logical question is, okay, what other banks do you consider mismanaged? And what sort of risk do they have? And what are you doing about it? Right? So I think that they've sort of opened up a can of worms. The issues that SVB and Signature Bank had were unique, but what caused their failure is not. It's a bank run. And for now, they've stopped it. But you know, we've all been through something similar to this. This is not the global financial crisis. It's not going to become the global financial crisis. But I would be surprised if this is over by now.
So then let's open up the playbook. Where are you putting money? It sounds like you're not too keen to rush into some of these regional banks, for example, that may have been unfairly beaten up.
No, I'm not. And I think it's not even so much because I'm concerned, you know, that they're going to be insolvent. I mean, there are a lot of very good banks here in the United States. People don't need to be worried about their money. But at the same time, they face very difficult business environment, right? Regulation will undoubtedly go up. The cost of that regulation will go up. Loan demand is falling as the economy slows. So I don't think banks are a great place to go for reasons besides what's going on with the crisis. Instead, I much prefer the defensive sectors. So your consumer staples, your healthcare. The economy will slow. And the only question is how much, enough to cause a recession or not. In that slowing economy, I want very high quality cash flow companies. I want companies that are in sectors that are impervious to a slowing economy. That's also why super cap tech has benefited.
And, the knock against it has always been price. You're paying too much for this sector. Do you spend much time obsessing over that?
No, not in environments like this, right? Because in a scared market, fundamental valuations don't matter, right? It's return of capital, not return on capital, and people want to be in an Apple, in a Google, or in a great utility like NextEra, or in a consumer staples, because they know those businesses will continue regardless of what's happening with the banks.
What about gold? Is that a defensive play for you?
Yes, I think it is. Absolutely. I think that gold has demonstrated its value, right, over the past couple of weeks. It's had a nice run and it's done exactly what it should, which is be that store of value when there is significant financial uncertainty. I've long believed that gold has a place in everyone's portfolio, and this is exactly why you should have it.
And going back to kind of the banks and where people put their money, you're getting almost nothing in deposits. And so there's been this argument of when is everybody going to wake up en masse that you should just be in a 6-month T-bill, which is super safe, super liquid. Is that an argument that you agree with?
To a point.
Oh, did we have him or did we lose him? Okay, just re-say your point on that because we lost you just as you started talking, Tom.
Sure, no problem. Yeah, I do think that there's an argument to that, but people have to be sure they can leave the money there for 6 months, because if you try and sell that T-bill before then, you may take a principal loss. Remember, bonds go up and down like stocks if you don't hold them to maturity. There's value to that, for sure, and that will continue to be attractive.
All right.